right? Line 31, your add backs are depletion, depreciation, business use of home, mileage on page 2, minus line 24B. So the only thing you can add back on this one is going to be depletion of $1,000. All right, line 13 doesn't show any depreciation. You could add all that back in if they did. They didn't tell the government that they have a vehicle, all right, owned by this company. So we can't add back in mileage. Watch out for that. Sometimes there's an Uber driver who rents a vehicle, but because the company doesn't own the vehicle, I can't add back in mileage. The company has to own it and report that they own it, which they do on this line, line 9, okay? And then 24B is minused out because it's the unallowable source of cost of travels and meals, which is usually 50% of the total cost, depending on how much they make. Line 30, business use at home. We can add that back in, which always is good. But for this one, it's just the 1,000.
Lori, this is super helpful. Thank you. Could you give a more better definition of the word depletion? Like, I have been told that was by CPA that was in relation to like the value an owner gives to their business. And so, but I just don't see depletion all that often. Do you have a good definition of what that really is?
Well, I've got a great definition of depreciation.
Yeah, I understand depreciation, understand car and truck, meals, and even business use at home. I kind of get, but like, I just don't see it that often. But sometimes as, loan officers, we're talking to people and we're saying, hey, you're not going to qualify this year. You need to file next year. Talk to your CPA. Here are the boxes that you can put, like, for example, like I've had some CPAs talk to a client and say, hey, you're claiming marketing expenses under advertisement, that 2,000. Hey, were any of those advertisements possibly things you could depreciate? And then they move it from advertisement, a portion of those, if they feel like the CPA can make an argument. I had someone make an argument that, hey, the business owner had grown significantly over the last year. So they actually, I think, put his salary or like some of his, like, I don't know, like they put it back into depletion because they were like, he is adding so much value to the company and it's doubled in the last 2 years. But I've only seen depletion one time in my career, and I would love to learn more about it if you have any insight on that.
In general, all I can tell you is that it's a non-cash expense.
Okay? Non-cash. Okay.
It's a non-cash expense, which is why we add it back in. All right. It lowers the cost value of an asset. And usually I don't see this unless it's somebody who's like in timber or mining or petroleum industries. It's just like depletion. It's a non-cash expense. Okay. It doesn't affect cash flow, right? So, but I can dig more into that for you.
Yeah, no, if you can, but that's good for now. Thank you so much. Keep going.
Okay. So we got our basic calculations for Schedule C. These are the only add backs: depletion, depreciation, home business, and then mileage. And just watch out for the husband and wife if they're both on the Schedule C, but not both on the loan. We're going to cut it in half. Okay, I'm showing you this because some people get confused when they see this first page, like how can I have income? So this is a partnership, all right? It's a husband and wife. And page 1's blank, okay? And sometimes this gets confusing. I do want to point out a couple things though. Up here, it says rental, okay? So I already know this company is not selling any goods. It doesn't have any cost of goods, which is why page 1 is blank, but that doesn't mean that the borrower doesn't have income. All right. And then if you see this final return check, this final box, it means he's closed it. This business doesn't exist anymore. He's told the IRS it's the last time he's ever going to file this. All right. I just want to point that out too. So page 1, yeah, it's totally blank. Okay. But Oh gosh, did I put page 2 in here? Page 2, which is your not test technically page 2. This is like page 4 or 5. But your schedule L, it owns a building. It owns a huge building. Okay. So it owns a rental property, which actually is a commercial property, right? And it even has some cash reserves. All right. So page 1 might be blank, but page 3 or 4, schedule L, which actually is a balance sheet, shows it has a building. It's a commercial building that they own. Let's see if I can find that. And it is on flowing to page 8825. Okay. It's coded 4 for commercial building. Okay. It is owned by this 1065, this partnership. It is the only thing the partnership owns, which is why you don't see any ordinary income on page 1 of the business returns. All right. And this is their bottom line. Okay. They're claiming all of the mortgage interest, all of the income. They've got their depreciation, all their expenses. Their bottom line is $208,643, right? Now, this 1065 flows to the K1. All right. Same business. They have 26% ownership in this rental property. You are not going to calculate it as a rental because it's owned by a business. This is seen as business income. All right. And if you want to do the math, $208,643, their ownership is 26%, and that equates exactly to the $54,247. Okay. I'm not going to give you this because I only dispersed $43,510. I'm going to give you the lower of the two, but that's exactly the 26%. That's their share. Any questions on that part? Okay. I can't see any electronic hands. Just let me know, Jax.
Oh, let me check to see. I haven't seen it close, but that's super helpful. There is, I guess you might answer it later, but there's there's two kinds of K1s. There's like the 1065 and then there's like an 1120. And I see sometimes where like you don't give the income if that distribution box is not filled in. A lot of times I see it like with a D on there with like the 1120 and then so there, can you elaborate me a little bit more on if the distributions line is not filled in, you don't give income? Is that correct?
That's exactly
No.
what I was going to ask.
No, it means I analyze you further. Okay. So, and I'm going to get into that. So
Okay, if you're going to get into that later, yeah, keep going. That's what I thought. Okay, keep going.
Okay, but yeah, there are many, many different types of K1s. Okay. When you've got a 1065, your distributions are labeled as an A on line 19. When you have an 1120S, your distributions are on line 16 and labeled a D. So yeah.
That's very helpful.
It changes. You can also have distributions on a K1 from a trust that flow to capital gains, Schedule D. You can have K1s from a trust that flow to page 2, Schedule E as income. As trust income on part 3, I think, but we'll get into that. Okay,
yeah, keep going because that's definitely a question I have. Is what do you do when there's no distributions listed? So keep going.
Oh yeah, we're definitely going to go there. Okay, just a general view of K1s right here. This is an 1120S. Like I said, line 16D is the distributions. It is in line with their ordinary income. I'm going to use the lesser of the two. I love it when I see this. This is like a slam dunk. I really don't need to look at anything else because I've got this, right? Until you give me that P&L and balance sheet, that's when things can take a south turn. But for now, the company's looking healthy, right? 408,000 paid out. And I wanted to point out, it is not a final K1. This business is active, beginning and ending. Pay attention to that. If this company files a fiscal year, it's going to say ending October let's say October 15th, 2019, guess what? That is your most recent tax returns because it's not due until October 15th, 2020. Did I get that right? Yeah. All right, I'll double back on that. Anyway, just pay attention to the fiscal year for the most recent. Okay, I'll double back.
Hey, Lori,
Yeah.
can you clarify? So what are the implications of the fiscal year being, like, let's say their fiscal year is different from the calendar year. Is there any difference in the way you need to calculate the income, or is it just more so that, hey, a new tax return may be available at this point or be required? Is that the thing to pay attention to?
A fiscal year is always 12 months, unless
Right.
they just started the company, right?
Yeah, exactly. But what I mean is, like, if it doesn't mirror the calendar, like if fiscal year is different than a calendar year.
Well,
Oh,
the whole point of the fiscal year is for a business to truly represent its true revenues when it makes most of its money during a particular season. So your tax returns are going to represent 12 months of that fiscal year. That K1 is going to represent 12 months. Does that answer the question?
Yes, it does.
Okay.
Thanks.
All right.
Sorry,
Okay.
I just got called out by Jackson for interrupting you. So I will put things in the chat box.
No, I just chatted again. I was saying you feel more comfortable chatting. So you can ask a question verbally, that's totally fine. But for anybody else that's maybe not as bold as Holden is, you can also put your question in the box and I'll ask it for you.
Perfect. Great.
Okay. All right, moving on. The K1s, this is the confusing part for everybody. Why are they paying taxes on income they didn't get, right? In short, it's because it's a pass-through company and somebody's got to freaking pay it. Okay. I don't care if you took your money out. I don't care if you did, but all pass-through companies, all the income, all losses are cut on K1s to their share owners, and they pay taxes on it whether or not they took the money. Now, they're never going to pay taxes on it twice once they do take the money, or if they leave it in as retained earnings, right? That's just going to flow to Schedule L, line D, and cash the company has, right? So if they don't have a distribution, does it mean the company is hurting? No, not at all. There are many reasons why a partner or a shareholder would leave their income in the company. They might need to expand. Okay, they might be looking to hire more employees. Does not mean your company is hurting, right? But I'll show you what a hurting company looks like. So when there is no distributions, it's not that we're not going to use the income. We're going to go look at your business returns or your P&L and balance sheet and see if your company is healthy, right? So this is 1040's personal tax returns. It's real tax returns, which is why I had to black everything out. Sorry. But it was a perfect example of a healthy company until one moment in time. So this borrower has a business that's making 400,000, has wages 131. Okay. Their business, which flows to page 2, Schedule E, is an S Corp. So I know I'm looking for 1120s. All right. 1120s means, yeah, that W-2 could be from the business and I'm going to have a K1, right? That W-2 line 7 wages could be the husband's income. You never know. But right now we have an S Corp. It has a profit, 400 grand. It looks beautiful. And then here's our 1120S. Okay. We got gross receipts, 604,000 minus cost of goods sold. So their total income is 592 grand, right? Business is doing good. It's got compensation to officers. There's my W-2. Okay. And then it's got ordinary income. Your ordinary income is what flows to a K1. Your compensation to officers is what flows to a W-2. Okay, we've got two sources of income here.